Hello, everyone. Welcome to Rule Classroom Live. Albert Liu here, alongside Rick Rule and Paul Harris, editor of the RIM newsletter. Gentlemen, welcome to the stream.
Thank you, Albert.
Hello, Albert.
Good to see you guys. Before we get started, I just want to let everyone know that we're going to be hosting our part two of Rick Rule's Gold Bootcamp this Saturday. In this event, we're going to be focusing on the highest quality gold companies, that is high quality junior producers and the highest quality senior producers. Rick, what can folks who attend this event on Saturday expect to see?
Albert, if people believe like I do, that gold will continue at the same price or go higher, the gold stocks relative to their net present value at today's gold prices or relative to their cash flow at today's gold prices are at almost historic lows. And if you believe that the gold price stays where it is or goes higher, we expect a major re-rate in the gold mining stocks. And contrary to popular opinion, you don't have to be involved in the speculative penny juniors to make money in a gold equities bull market. If you will look at a history as an example of the XAU over the last 40 years, the truth is that the biggest and the best gold mining industries, the 30 or 40 biggest stocks in the industry, generated 200, 300, or 400% returns over a gold bull market. I would suggest that we're a quarter of the way into this one. And so investors who don't want to subject themselves to the risk or the volatility of the juniors can invest in the best of the best in the sector and enjoy truly outsized profits by merely participating in the beta of the sector. Investors who aren't familiar with the terms beta and alpha in the way that we use it should consult the Rule Classroom lectures about the difference between beta and alpha for a great overview of beta in gold stock bull markets. But my suspicion is that the best is in fact ahead of us, and that the move in the gold price has to some degree de-risked the moves that you might expect in the juniors, despite the fact that several of the seniors that we'll talk about, the Franco Nevadas, the Wheaton Preciouses, the Agnico Eagles, have already delivered 50% gains.
Rick, we have a great lineup, obviously featuring yourself, but joining us will be John Hathaway from Sprott.
John is exactly the kind of person that we want. He has been involved as a large-scale gold mining stock investor for 40 years. It's not like he was put in place to cover the sector after the gold price went above $2,500, after having failed at crypto and having failed at automobile analyst or something. This is a guy who started his career as a value analyst in the 1970s and moved to the mining space and has been principally employed as a mining equities analyst and portfolio manager for 40 years. This is not John's first rodeo. He has great analytical skills. I've known him personally, being a client of his, a competitor of his, a cohort of his for a very long time. I have a very high regard for John. In addition to that, John is a great speaker. He's a great communicator. It's one thing to have people who are wonderful analysts but are a bit tongue-tied and can't teach. John can both do and teach, which is a rare combination.
Absolutely. That's this Saturday. Go to bootcamp.ruleclassroom.com for information. Rick, I'm looking forward. We're getting prepared for this event right now, actually. So looking forward to people joining us. And also come to the Rule Classroom, ruleclassroom.com, where you can watch many primer videos on investing in natural resources, probably, I don't know, more than 15 hours worth of just Rick talking about various aspects of natural resource investing, including the alpha versus beta video. And there is no charge to join the Rule Classroom. Now let's get on to the business of today, Rick, because we have Paul Harris joining us, the editor of the RIM newsletter. Paul, and today you're going to be talking about royalty streaming companies. Give us a little overview of what you're going to be talking about today.
Well, that's right, Albert. Thank you for the introduction. We published our latest issue of the Rural Investment newsletter about a week ago, so this is the Q&A for that. In the newsletter, we basically go through the ins and outs of the royalty space, starting from the very beginning of what a royalty, what a stream is, looking at some of the pros and cons, why companies, how this has become an alternative source of finance for the mining space over the past 20 years, and consequently how it has grown into a space with a lot of companies, some of which have higher valuations than some of the biggest gold companies.
All right. So why don't we get into it then, Paul?
Absolutely. And so hopefully our listeners, our viewers will provide you with a primer to the royalty and streaming business model, why it works so well in the mining space, as well as some different investment approaches that one can take. Before we get going, please note that we now also distribute the newsletter via Substack. So look out for the link to get that, or you can sign up for that at realrickrule.substack.com. That's realrickrule.substack.com. Also, we would like to hear from you about the topics you potentially like us to cover in the newsletter going forward. So please send us your suggestions via email or in the chat in this Q&A session. Our next issue will be a focus on gold M&A, for example. Now, in terms of royalty and streaming companies, this is a great topic, and there is a whole Rule Classroom bootcamp of materials available for people that will be a great primer to get much more in-depth about the space from some of the leading lights, some of the leading participants in the space. And this will be great for those of you who are going to join us at the Rule Symposium on the 7th to the 11th of July, where we have 4 royalty and streaming companies participating. Those are Wheaton Precious Metals, Osisko Gold Royalties, Elemental Altus Royalties, and Empress Royalty. Over 1,000 people have already registered to attend in person in Boca Raton or via our live stream, which I will be hosting. Now, in the past 21 years, the royalty and streaming space has grown from an idea to become one of the most vibrant and important sectors in the mining investment space today. And it now includes some of the most important companies in the mining and energy sectors, as well as becoming a key source of financing for project developers. There are more than 25 companies in the mining, royalty and streaming space, worth an aggregate $95 billion of market capitalization, and at least 20 with an aggregate of $50 billion of market capitalization in the oil and gas space, for a combined market capitalization of about $150 billion. In the metal space, royalty and streaming companies have deployed about $45 billion in nominal dollars since 2004, of which 72% has been via streams, 27% via royalties, and 1% via other financings. Senior producers have received about 40% of those funds, mid-tier companies about 36%, and the juniors 23%, while 45% has been invested in copper projects and 37% in largely gold projects. Now, the top 2 royalty and streaming companies in the precious metal space are Franco-Nevada and Wheaton Precious Metals. They now have higher market capitalizations than Barrick Gold and can be considered the 3rd and 4th largest precious metals companies, respectively. And they represent about 80% of the value of the sector. Royalty and streaming companies have a lot to offer investors, as we will explain as we continue through this Q&A. And we will include at least some of the main names that are active in the space that investors may be interested in. Now, let's start with some sort of definitions. What is a royalty? A royalty is a payment right tied to the production or sale of a mineral product, often calculated as a percentage of gross revenue, a gross revenue royalty, a net smelter return, or an NSR, or net proceeds royalty, which is an NPI royalty. A stream, on the other hand, is an agreement that allows a company to purchase a portion of a mine's future production, often at a discount, in exchange for upfront financing. Now, important thing to note when you're looking at royalty and streaming companies is that when you look at their balance sheets, when you look at their income statements, streams tend to generate higher revenues, more revenues than due to the direct delivery of the metals that they receive, while royalties are more of a passive income stream. They're complementary in many ways, but companies that have streams tend to have much higher, stronger cash flows. Now, why is a royalty or streaming financing attractive for a mining company or for a project developer? Firstly, they avoid share dilution, which occurs with equity financings. Many CEOs, or most CEOs, are allergic to dilution. There is dilution on the balance sheet because royalties are always present on the balance sheet. It's very rare that they can be extinguished, although there can be provisions for them to be reduced or bought back, particularly if there is an M&A transaction involving the company or the project that a royalty or stream is on. Streams can be also restricted or limited or reduced in nature over a period of time with a scale down. So they avoid share dilution for mining companies. They are also more flexible than bank debt. They don't come with a long list of covenants and other things that can reduce the operational flexibility of the company that takes out the financing. And it also allows a company to monetize its byproducts, such as silver or gold from a copper project, or other such things. This has been one of the principal reasons the sector has grown so much. Companies like Franco-Nevada and Wheaton Precious Metals they've gone out to the big copper producers around the world and said, look, we'll give you a big check today for a royalty or a stream on your precious metals production going forward the next 20 or 30 years, or indeed indefinitely. And mining companies have been keen on that because it enables them to get a lot of money up front right now today, which they can use to help strengthen their balance sheet, pay down debt, or give them other financial flexibility. Now, what about investors? Why are these good vehicles for investors? Well, first of all, it gives you exposure to production from some of the best mines in the world without operational risk. Because the royalty or streamer, they get paid no matter whether the mine makes money or not, because they get paid either, their payment is related to the metal production, either as a percentage, a royalty percentage, an NSR, or they actually receive the physical metal. So regardless of what the cost structure of the mine is, they get paid. They get paid first. Royalties and streams also tend to be high margin. Now, a royalty and streaming company will typically enjoy margins of 75, even up to 90%. Compare that with a miner whose margins may vary from 30 to 50%. Even in this day and age, when we are at record gold prices, a pretty good copper price and a pretty good silver price, the best companies are only achieving a margin of perhaps 55 to 60%. So the royalty and streaming companies have much better margins and can be much more profitable on various different metrics, such as revenue, revenue per share, or revenue per employee, things of that nature. Now, royalty and streaming companies give investors the potential for compounding as more discoveries are made on the property that the royalty or stream relates to. When a royalty or streaming deal is struck, it's the royalty or streamer will provide a certain amount of money for the right to mineral production on a certain area. That's sort of fixed at that moment in time. However, oftentimes the miner or the developer will continue to explore and continue to find more mineralization on that concession or on that area of interest, which the royalty and streaming company, and therefore its investors, get free of charge. It doesn't have to pay more for that. The royalty and streaming companies also have great resilience in inflationary environments and other commodity downturns, in part because they have very low operating costs, they have very few personnel, they are more of a financial construct rather than an operating construct. And finally, it gives investors exposure to a large basket of different projects. A mining company, even the biggest mining companies, may only have 10 mines or 15, including projects, 15 properties. Royalty companies, the biggest royalty companies, will have dozens, if not hundreds, of royalties and streaming agreements. Now, royalty and streaming companies, their cash flows are valued much more significantly higher than the cash flows from traditional mining companies. So, for example, a royalty cash flow maybe have a valuation of 15 times free cash flow, whereas a base metal producer may have a valuation of 6 times free cash flow. This valuation uplift means developers can also raise capital from a stream, more capital from a stream than through equity, and at a lower cost of capital. Because of their robust financial position, royalty and streaming companies enjoy some of the lowest costs of capital in the mining space, and they can therefore pass some of that benefit on to their clients or their prospective clients. However, that's not to say that there aren't risks and challenges in the mining and royalty space. The first one, the most obvious one, of course, is that a royalty or stream only becomes valuable once a mine enters production. Until that time, the royalty and streaming company doesn't receive any money. In fact, it's paid out money to acquire that royalty and stream, and sometimes the mines may not come on for a couple of years, 5 years, 10 years, or even longer. Now, projects, of course, may stall due to political, environmental, or other technical issues, as we saw very, very dramatically at the end of 2023 when Panama shut down the Cobre Panama mine. Only a little while before that, Franco-Nevada had invested $1.5 billion into First Quantum Minerals to get access, to get exposure to that mine. And so that was a big hit for Franco-Nevada at that moment in time. They've currently got an investment dispute open against Panama. I think they're looking to claim damages of about $5 billion US. Now, the smaller companies in the space may face cash flow constraints and higher cost of capital. They're smaller companies. They've got a smaller amount of royalties and streams, so their cash flow generation isn't as strong as for the larger companies. And so capital management can be a thing to watch out for there. Now, the royalty and streaming space breaks down nicely into sort of pretty distinct tiers, giving investors different types of company to invest in. From the blue chips, the top tiers, we've mentioned Franco-Nevada, we've mentioned Wheaton Precious Metals. These are part of the top tier that have market capitalizations of more than $5 billion US. Also in that group is Royal Gold, Osisko Gold Royalties, Texas Pacific Land in the oil and gas space, Prairie Sky in the oil and gas space, and Freehold Royalties also in the oil and gas space. So these are perhaps investments better suited to people that are more conservative, that have a much more long-term focus, and perhaps even those that are seeking stability and sustainable dividends. However, it should be noted that while most of these companies do pay dividends, their stock tends to be valued very highly, and so their yields tend to be quite small. Then we have a mid-tier of companies between $100 million and $5 billion of capitalization. These often are companies with lower quality assets or higher risk assets because they have their balance sheets are much more limited, so they are unable to compete for the best assets. In this space, balance sheet is everything. Having the best balance sheet means you have the lowest cost of capital, which means you can offer better terms to any potential royalty or stream seller. There's a lot of competition in this space, and we do expect that there should be some mergers and acquisitions for consolidation. Why? Because cost of capital is everything in this space. So consolidating to get a stronger, bigger, better balance sheet makes a lot of sense. However, there are factors that impede that because obviously as and when organizations consolidate and get together, a bunch of people lose their jobs. And finally, of course, we have the junior or the speculative end of the market. These are the smaller companies with the sub $100 million market capitalizations. Again, they're much higher risks due to their scale limitations and their capital constraints. And they tend to innovate or specialize to have a unique selling point or competitive edge or technical edge or something of that nature. We've seen a transaction recently in the past couple of weeks whereby Triple Flag is acquiring Orogen. They're acquiring it for one specific royalty that Orogen holds, and that's the 1% royalty NSR on the Silicon Gold project in Nevada, which is being developed by or advanced by AngloGold Ashanti. That is going to be a generational royalty for Triple Flag, and they were prepared to pay handsomely for that, and also to allow Orogen to spin out everything else that the company held into a new company. Now, that's my notes for the overview. And so let me bring in Rick to provide the Rick Rule view of things on top of this.
Well, that was, in fact, a great overview, Paul. Thank you for that. And thank you for a wonderful issue of the investment newsletter. For those of you who are new to these podcasts, understand that the newsletter itself is very much a joint venture, but Paul is the one who is really responsible for bringing it to you. I do the sort of oversight, some of the stock selection, some of the theme selection, but Paul is the one who translates my musing into English. So, Paul, thank you for that, and thank you for your efforts on today's podcast. I want to start by talking about royalty and streaming companies, not from the point of view of the industry, but rather from the point of view of the investors. When I was active as a portfolio manager for individuals, for some individuals, I constructed their entire natural resources investment portfolio out of royalty and streaming companies. I did this for investors who were primarily interested in getting the beta associated with the resource market without having to take operational transactional risk. which is to say that I could construct portfolios that were senior mining portfolios, as an example, the Francos, the Wheatons, a junior portfolio with some smaller royalty names, a speculative portfolio around prospect generators with a royalty components, the Altiuses, the EMXs, the Origins of the world, and also an oil and gas royalty portfolio. It is possible, and in some cases preferable, to construct most or all of one's natural resource portfolio in the royalty and streaming space. Why would you do this? Several reasons that I can think of, the most important of which is avoiding operational risk and avoiding the management, general, and administrative expense associated with being a mining or an oil and gas company. It has been pointed out at Franco-Nevada, the largest of the royalty companies worldwide, that they operate that royalty company with a total staff, including clerical people, of less than 40 people. The exploration department in a major mining company, a mining company of its size, would have more exploration professionals than Franco-Nevada has total people. So not only do you excuse yourself from the exploration expense, the capital expense, the sustaining capital expense, the operating expense, you also have much smaller, general and administrative expenses in the royalty companies. As Paul pointed out, the royalty and streaming companies have margins that vary from 60% to as high as 90%, and that's burdened by much lower general and administrative expenditures. The fact that the royalty and streaming business is a better business than other natural resource extractive industry companies means that you often get a better class of professionals associated with the business. It's no surprise that the financially sophisticated entrepreneurs in the extractive industries have gravitated towards the royalty space. So in addition to enjoying a better business, you also often get better business people associated with the transaction, and the transactions are more exclusively financial. That doesn't mean that great technical due diligence doesn't come into the play. The royalty and streaming companies have to make their investment allocations on very, very rational financial decisions. So good technical due diligence is required, but the company is less responsible or not responsible at all for ongoing operational or technical decisions, which is the province of the company that is paying the royalty or the stream. We've talked before about capital risk, but let's talk about it again. These are financial instruments. These companies are not required to put up the upfront capital cost, with the exception of the capital cost to buy the royalty or the stream. And they aren't required to make financial contributions to sustaining capital or operating capital risk. It's important to note, too, in the smaller end of the business, that when one is building a company, building towards scale, whereas an exploration company is an all or nothing outcome. And even when it's all, can require 5 years or 6 years or 7 years to come into production. The fact that royalty and streaming companies often enjoy current cash flow means that building towards scale, meaning that building towards the time when they're generating more than sufficient free cash flow to justify the operating and general and administrative expense, can come more quickly. The smallest company, I think, in our survey, Empress Royalty, a small speculative company, generates enough money in royalty and stream to cover all the general and administrative and evaluative sense and still add cash to the register. It's important to know that these companies build scale relative to G&A faster than happens in any other business. As Paul points out too, the cash flow that's associated with no additional capital cost expense and no operating revenue, that is to say, isolated cash flow, is recognized by the market as being more stable and hence more valuable. So cash flow that accrues or inures to a royalty and streaming business is valued at a premium to that same cash flow should it occur in an operating business. And finally, segregated cash flows for precious metals are valued more highly than revenues from base metals companies. What that means, as Paul has correctly pointed out, is that when a company, as an example, is building a great big porphyry copper mine, he mentioned Cobre Panama, where the primary production is copper, but where gold and silver is also produced, the royalty and streaming company can prepay for that gold and silver and can pay a disproportionate amount of the capital cost to put the mine in production in return for a smaller part of that revenue stream, understanding that the revenue stream is unblemished by cost and is focused on gold and silver, which generally command higher multiples in the market than copper. A further advantage to this is that in decent markets, there is less downside risk associated with royalty and streaming companies because the merger and acquisition market is so fulsome in these markets. To the extent that a company is less able than its peers to grow, it isn't an all or nothing, succeed or fail business. These royalties and these streams, the portfolios in the companies that are stuck, can command a premium in the market. And what that means is that rather than losing most of one's money in an unsuccessful effort, what frequently happens in the royalty and streaming space is that the management team who feels stymied or stuck can sell out to a bigger company with a lower cost of capital. A wonderful, wonderful bailout for investors. As Paul also notes, from the issuer's viewpoint, that is, from the point of view of the company that sells the royalty or the stream, because the revenue that results from the sale of a royalty and stream commands a higher multiple isolated as a royalty or stream, the royalty and streaming company that buys that from the issuers can pay a disproportionately high percentage of the production cost or the capital cost relative to the stream, understanding that the stream, although it might only be 20% of the equity, might be 50 or 60% of the operating income, given the fact that it's unburdened by success. What that means is that a development stage company, which is faced with, say, $1 billion development charge, of which 350 million may be equity, may be able to raise 200 million of that 350 by selling a royalty and stream on only 20% of the sales proceeds of the total mineral stream, meaning that the shareholders of the company which will own and operate the mine are only putting up 150 of the 350 million initial cost, while getting the primary part of the cash flow from the main metal, be it copper, be it lead, be it zinc, reporting to their own issue. So in that sense, there is much less upfront equity dilution to the issuer by employing a royalty or a stream. Another aspect that I think needs to be discussed, particularly with the big royalty and streaming companies, is that you get access to exploration upside. In my experience, 50 years in these markets, what I've noticed is that big deposits, good deposits, tier one deposits always grow, which is to say that if you buy a royalty on a project, which is an uncapped royalty, and the company spends additional money on exploration and the deposit over time grows, your royalty grows. A wonderful example of this would be the Goldstrike royalty, which was bought by Franco-Nevada from Barrick Gold. If my memory serves me well, for an upfront payment of $2 million, Barrick got a 5% net smelter royalty and a 5% net profits interest in the Goldstrike mine, which subsequent to the purchase discovered about 45 million more ounces. That $2 billion initial capital expenses has thus far generated more than $2 billion in returns to Franco-Nevada, while at the same time, the mine and subsequent discoveries on the concession have generated more discovery ounces than have been produced in the life of the mine. A dramatic example, to be sure, but one example of why this sector generates exceptional investment returns over time. People have objected in the classroom, in fact, to the royalty and streaming space because they suggest it's too well known, that it's too highly valued, that the ability of the royalty and streaming companies to generate new opportunities is past. And I would argue that that's not true. I would argue that we're coming into a place in mine finance in particular where the opportunities will increase rather than decrease. There is no doubt in my mind that we are going to, within 5 years, face, as an example, a shortage of copper. We have not spent enough money looking for copper or developing copper mines for 20 or 30 years. And the truth is that the upfront capital cost to put a big copper mine in production, say in Chile or Argentina or the United States for that matter, can exceed $10 billion, an awful large transaction, even for a very large mining company. By isolating the copper and gold revenue, the silver and gold revenue from a copper mine, a major that is faced with a $10 billion upfront capital expense can acquire a disproportionate amount of the equity needed to put the mine in production with relatively small equity dilution relative to other types of financing. Paul, as we discussed in the letter also, it's my belief that increasingly host governments in frontier markets around the world would like to participate as equity participants in major mining projects in their countries. The problem is that they lack cash. The ability of the host government and the host operator to finance the participation via host governments in these projects by selling to a Franco-Nevada or a Wheaton Precious a royalty or a stream on this project can be a way that the host governments can have their cake and eat it too, and share the benefit of that both with the issuer and also with the royalty and streaming companies. I hope that rather long-winded overview has served to benefit our listeners.
All right. Thank you both, gentlemen. This is a great introduction. People, if you're looking for the actual document, you can go to ruleclassroom.com. It is posted there. Paul also mentioned where you can find it on Substack. We got some questions coming in. A good one from Zahara Sharif. Rick, let me just see if I can paraphrase here. The larger royalty companies, they have, quite large portfolios of royalties and streaming assets. Rick, how do they stay on top of updates and developments on all of these different projects?
The same way I do, Albert, which is to say with difficulty. The point is, however, that they don't have to make the operational and investment decisions around those assets. Mostly, the advancement is the requirement of the operator and the issuer. From the point of view of the royalty and streaming companies, they maintain an interest the same way that I do, a passive interest, which is to say an investment interest, which, while important, is much less onerous. As an example, on the aforementioned Goldstrike royalty in Nevada, the real decision in terms of investing the projects, which involves the expenditure of large amounts of money, is done by Barrick or Newmont. While Franco-Nevada is interested in the outcome of this, they don't have to know it as well as Barrick does because they aren't spending their money advancing the project.
Okay. You often talk about specific expertise, Rick, and this classification of company is very different than a lot of the other ones. How would you break down the specific expertise required in terms of, I guess, financial acumen, in terms of geological expertise, and compare those to the other types of companies?
This is more of a financial exercise. You have to do technical due diligence as opposed to originating the technical material, which is to say you don't need sophistication at grassroots exploration. What you're doing is that you are buying the product of grassroots exploration utilizing your own analytical skills after that success has taken place. This does require transactional expertise. The contract by which you put in place, perfect, and enforce the royalty and stream needs to be put in place extremely well. An obligation which is neither debt nor equity is hybrid, and you need to fit into the capital stack in a very intelligent sense. You also need to do, as Franco-Nevada did, some real work on political risk. It is worthy to note that while the government of Panama, illegally in my view, extinguished the mineral interest of both Cobre Panama and Franco-Nevada, they did it in a contract which was subject to international arbitration. Both First Quantum and Franco-Nevada are pursuing the government of Panama in international court, as is anticipated by the contract by and between both companies and the government of Panama, which is a function itself of the intelligent construction of the arbitration. If the letter of the contract is used in the court to determine Panama's liability, which is to say the net present value of the interest which is nationalized, Panama's obligation to Franco-Nevada alone would be $5 billion, a handsome premium to the $1.5 billion that Franco put in. And by the way, a number that's substantially larger than the Republic of Panama can afford. This is a letter, this is an example, pardon me, of the fact that analytical sophistication and transactional sophistication is what's required in this circumstance.
Rick, would you characterize that as a durable competitive advantage for Franco? And if not, besides the size of Franco, what would you say is a durable competitive advantage?
I think the culture at Franco-Nevada is a durable competitive advantage. They, because of their size and because they started off at the top, I mean, they got one of the best royalties that's ever been bought right out of the bag and got extremely lucky. What Franco has been able to do is look for things that move the dial, even on a company its size. They focus on extremely large deposits. They focus on transactions that are each individually over $1 billion. And there's a very narrow club of people, currently two, Franco and Wheaton, that can entertain a royalty or a stream that is of that size. A smaller royalty company can say to an issuer, yes, we will buy this interest for $1.5 billion, and we're highly confident that we can raise $1.5 billion. Franco can say, we like this and we'll write a check, not subject to anything. Scale is important to Franco and Wheaton, the same way that scale has been important to Berkshire Hathaway's reinsurance business. They can simply afford to write the check.
Albert, can I add something to that as well? In answer to the key skill set, it's definitely financial, because a lot of the royalties, when they come available, are subject to a competitive bidding process. So the bidders, the participants, the royalty and streaming companies need to have very sharp pencils on their numbers and what they're prepared to bid, what they're prepared to pay for a specific royalty. And a good illustration of that is one of the mid-tier royalty companies is Sandstorm Gold Royalties, which was founded by somebody that previously worked, I believe it was Wheaton Precious Metals, Nolan Watson. He's a finance person, and it's very much a finance-driven subsector. There, in terms of, even the big companies can have a specialization. As Rick mentioned, Franco-Nevada was the first, and it's the biggest. So everyone else has to compete with that. Wheaton's number two, but it's also found a way to try and compete and have a competitive advantage compared to Franco-Nevada. And that is that Wheaton Precious Metals often co-invests in social programs with the companies, the mining companies. It sees that as giving it a competitive edge over other royalty and streaming companies that don't invest in social programs at a sort of mining project level. it's not something they have to do. It's something they choose to do. Another example would be, we've mentioned Origin a couple of times so far. Their competitive advantage, they're a smaller company, but their competitive advantage is going out and exploring and generating the royalties that they then bring into their own portfolio. And then, like this one we mentioned about silicon, as and when these projects become something, they can sell them on up the food chain.
Rick, do you have a comment on that?
I do. I think Paul put his finger on something that investors need to understand when they look at the space, but particularly the smaller end of the space, which is to say durable competitive advantage versus cost of capital. There was a point in time when I was visiting with Pierre Lassonde, co-founder of Franco-Nevada, and he was telling me that I should show him more transactions in royalty and streaming where I was the lender, because his cost of capital was so low. He said, we're trading at over 2 times NAV because people value the purity of our cash flow, and they value the fact that our legacy deposits are going to grow. What that means, Rick, is that my cost of capital is lower than yours. And if you and I are competing on a file, you are going to lose and I am going to win, which means that you should introduce me to that file. So his durable competitive advantage is cost of capital and reputation. And you have to look throughout the stack. Wheaton Precious' durable competitive advantage is that they institutionalized an oil and gas product called volumetric production payment and made it into a mineral product called a stream. They are the leaders in stream financing. That's their durable competitive advantage. One could argue that Triple Flag's durable competitive advantage is their ability to package what they do with offtake agreements on behalf of commodities companies. In other words, they have a durable competitive advantage, a knowledge advantage in the capital stack around mine financing. As Paul stated, in smaller companies in particular, your definable competitive advantage is what's critical. If you participate in the market and just buy interests that are for sale at auction and freely available to everybody, it's likely that relative to your peers, you overpay. And that's difficult when you're competing against companies like Franco and Wheaton, if they want to, that have lower costs of capital. So in the case, as an example of our smallest company, Empress Royalty, their definitive competitive advantage is their tie-in to Endeavor Financial, which is a small financial services group which has been responsible for originating $10 or $12 billion in construction finance, which is to say Empress durable competitive advantage is better access to transactions that aren't auction transactions, but are rather negotiated transactions. The advantage that an Altius or an EMX or a Mondoro or an Origin has is that these are prospect generators. They originate their royalty interests by originating the investment concept and selling that concept to an explorer, taking back their interest by way of a royalty. That exposes them to enough transactions that occasionally they see a transaction that they can buy that they didn't originate. In other words, by having their ear to the ground all the time, they're able to find transactions before those same transactions find their way into a competitive market. The point of all this is that when you're constructing your own royalty portfolio and streaming portfolio, you need to look, particularly among the smaller companies, at companies that have definable competitive advantage and isolate what those are and only buy those where you believe them to be true and you understand them.
And another aspect to add on to that, pretty much every royalty and streaming company, somewhere on their website, they'll have their portfolio book where you can see in detail all of the projects that they have royalties and streams on.
Okay, Rick, I want to get to some questions here. From Alistair, asking about, and I know what you're going to say, but I'm going to ask this anyway. For the investor, thoughts on the relative allocation in a portfolio between different size classes of these companies, Wheaton versus an Osisko or a Gold Royalty. Rick, how should the investor be thinking about this?
3 determinants. Your risk tolerance. There are people who can't afford to take a lot of risk. They want to participate in natural resources, but they want to limit your risk. In that case, you allocate more towards the largest and most stable companies in the space. The second, I would suggest, is your time preference. To the extent that you see yourself in the space for a year or two, and you can't allow your investments to mature, again, you want to argue in favor of allocations to parts of the portfolio that are already mature. Particularly people like Triple Flag and Cisco that are reasonably decent dividend payers, or towards the oil and gas companies. The third is how much work you're willing to do, because how much risk you are willing to take should be directly related to how much work you're trying to do. We have told people, Albert, as long as we have had the Rural Classroom, that the number of speculative stocks that you own in your portfolio should correspond exactly to the number of hours that you are prepared to spend per month analyzing your company. There is a lot more to know about an EMX or an Acora or a Metalla or an Empress than there is to know about a Franco-Nevada. There's a lot more risk. There's a lot more contingent assets and contingent liabilities. So the extent to which you are chasing growth and chasing upside, which is more inherent in the smaller companies, also means you're chasing risk. And the way you mitigate that risk is by being willing to work yourself.
Rick, can I ask a follow-up question on this? Because it's an interesting question. When you look at the largest class of this company versus a smaller one, what makes the smaller one more risky? Is it on an asset basis? Is it lack of diversification? Is it the quality of the underlying projects? Is it the quality of the partners? What specifically would you say makes the smaller one more risky?
I would suggest the quality of the assets. If you look at Franco-Nevada, I probably 70% of the royalty comes, 70% of the revenue comes from 5 assets. These are big, long-lived assets. These are assets that were put into production when they had enough reserve to overcome the capital cost of putting them into production. What that means is that traditionally, these companies generate more reserves over their lifetime than they came into existence with. I mean, it's weird to do a net present value, and in a net present value calculation, most of the cash flow enjoyed after year 8 is valueless. But believe me, when year 8 comes and you reset that net present value clock back at 0, it's extremely pleasant. So in the case of Franco-Nevada, what you see is that there's probably more upside contained in their 5 largest projects than they have taken out of the projects during the period of time that they owned them. It is simply spectacular the way high quality projects are the gifts that just keep on giving. And they're always undervalued because guys like me start their analysis on a net present value basis. They take the present value of free cash flows and they discount them back at some number like 8%. What that means is that cash flows after year 7 or 8 don't have any value whatsoever in the net present value calculation. That's actually a silly way of evaluating an asset that has a 40-year mine life. It's just that no better way has been developed in my lifetime.
Yeah, they've invented the perpetual motion machine, Rick. That is quite amazing that this exists, at least in finance. Okay, with the few minutes we have left, let's try and go through more of these questions. You have to keep your answers brief, though. Cohen asks, regarding royalty companies in general, what is the preferred ratio of G&A versus royalty revenue?
There's not a one-size-fits-all answer. I guess the ideal is Franco-Nevada, where the last time I looked, it was 11 basis points, which is to say 0.11%, substantially lower than the cheapest ETF in the sector. By the way, don't be looking for that in smaller companies that don't have the same scale as Franco. There is no one size fits all.
Yeah, this is like in the limit as revenue goes to infinity, G&A goes to zero as a percentage of it. He follows up asking, what are the three most important metrics to follow?
Value, which is to say you or somebody that you have access to needs to determine what the portfolio is worth, what upside can be reasonably expected from the portfolio, and how well the company is run by somebody with regards to a metric that we've talked a lot about at the Rural Classroom called recycle ratio. Recycle ratio is the amount of reserve and resources that you can add to the balance sheet from the revenue that you generate from one unit. If you're measuring gold, as an example, and you are generating, if you're Franco, $3,000 per gold equivalent ounce, how many new ounces of gold can you generate on your balance sheet for investing the proceeds from the 1 ounce of gold that you just sold? Recycle ratios after G&A that exceed 1.25 to 1 are considered to be competitive recycle ratios.
Great answer. Okay, one more question from Zahara Sharif. It's a great question, actually. You see a trend, Rick, of tandem companies, a royalty with another company, Vizsla Royalty versus Vizsla Silver. The question is, how do you assess the prospects of these two companies, given that Vizsla Royalty's only project today seems to be Vizsla Silver Royalty? How do you assess the outlook for these two joined companies?
I think it really depends on the investor, and it depends on the investor's perception of the management team to grow Vizsla Silver, the Vizsla Royalty, I'm sorry. They segregated out the royalty from Vizsla because I think that they believe that once Vizsla achieves sufficient scale, it will be sold, and they will still have a job with the royalty company. Because the royalty cash flow will be valued at a higher multiple than the operating cash flow, they can expect a premium price in equity markets relative to the size of the company, and they will have the opportunity to try to either use their equity to acquire other royalties or use the cash flow from the Vizsla royalty to grow. Analyzing Vizsla Royalty, you will have to form an opinion as to the competence of that team to operate in the royalty business.
Okay, love it. Rick, over 2,000 people joining us across the various media platforms. And for those who joined a little bit late, I want to remind you that we have new interviews every week at ruralclassroom.com. We have an enormous archive of videos that you can take in, including all the live streams that Rick does at ruralclassroom.com, and a multi-part video series on introduction to natural resource investing. It's free to join. Check it out at ruralclassroom.com. And before we leave, I also want to mention that we will be hosting part 2 of our Gold Bootcamp this weekend, Saturday, May 10th. It's a whole day affair. We have some great speakers coming in, Rick Rule, of course, but also John Hathaway, Adrian Day, Joe Mazumdar. Rick, just a quick pitch, please, about what people can expect at this event.
Let's start with my promise. Any educational product that I sell or have sold for 30 years comes with an ironclad money-back guarantee. If you come to the Gold Bootcamp and you feel for any reason that you haven't got your money's worth, we give you your money back. There's nobody else in the business who does that. Why would you come to this boot camp? Well, if you don't like the gold business, don't come. If you're not prepared to work hard for 8 hours, don't come. But this boot camp will give you the opportunity to understand the basics of a business that I think have 5 years of very, very, very good runway ahead of them. Specifically, the gold mining stocks, the higher quality gold mining stocks, are selling at the lowest multiple to free cash flow and the lowest multiple to net present value that they've enjoyed over my career, or at least since 1975, which is to say that a sector which is attractive to me is also cheap, but you need to know how. You will have the advantage of listening to myself. I've done a reasonably good job as a gold investor going back 50 years, particularly if you excuse the year 1980. But also Adrian Day, who's been investing in the sector for just as long, and John Hathaway, who's been investing in the sector for just as long. In addition to that, you'll have access to the technical expertise of Joe Mazumdar, who's been an extremely successful first exploration geologist and then analyst with major multinational mining companies, now the publisher of his own newsletter. So you get a very different, much more geological and technical perspective. If all of this doesn't work for you, you have my solid gold guarantee that if you don't like what you hear, you will get your money's worth. It is meant, by the way, if you come to the boot camp, that you pay attention to the recordings, because we're going to give you more information this Saturday than you can possibly absorb this Saturday. We're going to give you access to the recordings, and you're going to need to use that access. And when you use the access, I want you to utilize the free lessons at the Rule Classroom. How to analyze mining companies, nosy questions to ask mining companies. It's important that the knowledge that we present to you in the 8 hours that you will spend, 8 or so hours that you'll spend on Saturday, it's important that you use that in conjunction with both the recordings and the analytical courses that we teach at the Rule Classroom. It's also important for those of you who really want to get your money's worth to initiate and participate in discussion groups at the Rule Classroom, specifically around this symposium. There's a lot of knowledge in the classroom. There's a lot of people besides the people who will be presenting. And I notice in the discussions now, rather than people needing to ask me the answers to questions, they're having those discussions among themselves. There's geologists, there's engineers, there's financiers, there's bankers. There's thousands of you at the Rule Classroom. Talk to each other. Talk to each other for the next 3 or 4 months, specifically about this boot camp.
All right. Thank you very much, Rick. And that's going to be bootcamp.ruleclassroom.com. Thank you, gentlemen. Paul, great job on the newsletter once again. Can you remind people, in addition to the ruleclassroom.com, where people can find you?
Yes, my email is paul.corresponsal@gmail.com. I'm on Twitter at Paul Harris Gold, and you can get me at Substack via the Rule Investment Media at realrickrule.substack.com. realrickrule.substack.com. Okay, can't wait to the next one, Paul. As in case you don't know, Paul comes out with these regularly, so within the next month we should have your next edition. Looking very much forward to it, Paul. Well, thank you, Albert.
Albert, I should also say, Albert, that future topics are partially dependent on audience demands. If today's 2,000 people are particularly interested in one subject or another, they should go into the discussion groups at the Rule Classroom and say, I'd like to see a future newsletter on. I'd like to see a future boot camp about. Our job is to serve our audience. We can serve our audience better if they tell us what they're interested in.
So yeah, come to ruleclassroom.com. We've already had several suggestions, Rick, which you and Paul are aware of. So we're looking forward to announcing those soon. But thank you very much. Thank you to all of the viewers today. Really appreciate your questions, and we'll see you next week.